Okay, so picture this. A company so innovative, so groundbreaking, so absolutely full of that it had Wall Street analysts comparing their CEO to Michael Jordan. Except instead of dunking basketballs, this guy was dunking billions of dollars into fake businesses. The stock, skyrocketing, the fraud, biblical. Welcome to Enron, the company that proved one thing definitively. Most people on Wall Street couldn't analyze their way out of a paper bag. This is Why Stocks Go Crazy. All right, let's set the scene. It's 1985. A company called InterNorth, absolute snooze fest of a name, is hauling natural gas around America. Boring, predictable, making billions, but boring. Then they hire this guy named Kenneth Lay as CEO. Now, Kenneth Lay is obsessed with image, and I mean obsessed. He drops $100,000, that's 1985 money, on focus groups just to come up with a new company name. They settle on Enron, modern, sleek. Sounds like a tech company. Spoiler alert, it's not. Fast forward to 1989. Enter Jeffrey Skilling. This guy, and stay with me here, this guy walks into McKinsey and Company with what he thinks is $1 billion idea. And honestly, it's not a bad idea on paper. Here's the pitch. Instead of actually producing and delivering natural gas, doing work, Enron would just guarantee prices to utility companies. Customer wants certainty, pay us a premium, we lock it in. Simple, elegant, makes sense. Kenneth Lay absolutely loses his mind, because here's the thing about Kenneth Lay. He doesn't want to own power plants or pipelines anymore. That's capital intensive, that's slow. He wants to turn Enron into a high-growth financial institution. Yeah, you heard that right. An energy company decides to become a hedge fund. What could possibly go wrong? So they create the Enron Gas Bank. They hire traders, not engineers, not scientists, just absolute smooth brains who got good at Excel and wore suits. These guys start buying and selling contracts like they're playing poker at a casino. And here's where it gets wild. They start trading everything. Natural gas, check. Electricity, check. Lumber, why not? Weather. They literally started trading weather contracts. Like, oh, it's gonna be rainy, let me short the umbrella market real quick. This is the kind of energy company a MBA student dreams up after 3 energy drinks and 0 sleep. But wait, it gets better. It's late 1990s. The dot-com bubble is pumping. The internet is all the rage with investors who have 0 critical thinking skills. Skilling sees this and thinks, you know what? We should own the internet too. In 2000, they announced they're building a nationwide high-speed internet network. They're going to trade bandwidth like it's gold futures. They're going to create financial markets for things that have literally never been traded before. This is revolutionary, they say. This could be worth hundreds of billions, they promise. And here's the thing that kills me. Wall Street believes them. Not because they did the math, not because they understood the business, but because the stock price was going up. That's it. That's the analysis. Let me break down the actual numbers so you understand how badly people got played. 1994, $9 billion in revenue, 2000, $110 billion in revenue. In 6 years, they went from a real company to, well, we still don't know what they were. But the stock, it went from $20 to $90 per share. Market cap hit $60 billion. That's 60 times earnings. You know what that means? The market was betting that this company would grow at astronomical rates forever. One Goldman Sachs analyst, Goldman Sachs, literally said Enron was like Michael Jordan. You don't know exactly how he's going to score each game, but you know he almost always wins. Imagine being paid millions of dollars to compare a company to a basketball player. And people listened. Here's where the fraud actually gets sophisticated, because it's not like these guys were just making stuff up and hoping nobody noticed. They had a system. Remember when I said these businesses were actually failing? Yeah. The broadband division that was going to make them $40 billion, losing billions every year. The Enron online marketplace, hemorrhaging cash, tens of billions in debt piling up. So Kenneth Lay and Jeff Skilling hire Andrew Fastow as CFO. Now Fastow, this guy is a creative accountant. And by creative, I mean he invented basically 3 new forms of financial fraud that the accounting industry had to name after him. His first move? Mark-to-market accounting. Here's how it works. You make a deal with a customer. You estimate what future profits might be, and this is generous estimation, and you book those profits immediately, as if they already happened. Example, in 1999, Blockbuster and Enron shake hands on a movie streaming business. Enron's accountants, just guessing by the way, say, yeah, this will make $110 million in profits eventually. So they write down $110 million in profits on their books. Today, right now, before serving a single customer. Does the deal fail? Were the estimates wildly optimistic? That doesn't matter. You just take a write down to cancel it out. Except when your entire business model is based on deals failing, write downs get embarrassing. So, enter Fasto's second trick, special purpose entities, SPES, ghost companies, money laundering schemes with a corporate PowerPoint deck. Here's how it works. When a deal goes bad and creates a loss, instead of admitting it on Enron's books, they transfer it to an SPE. Technically not on the balance sheet, technically separate, but they control it, they fund it, they use it. By 2001, these entities, and there were hundreds of them, were holding tens of billions in Enron debt and accumulated losses. Fasto personally controlled these things and literally stole hundreds of millions of dollars from the transactions. Just skimmed it right off the top. And here's the kicker. Skilling and Lay probably knew about this, but it didn't matter to them, because without these fake entities, the entire fraud collapses. Now, there's one more player in this game of financial musical chairs, Arthur Andersen. You know, one of the big 5 accounting firms, one of the most prestigious auditors in the world. They were Enron's auditor and their business consultant. In 2000 alone, Enron paid Andersen $50 million in fees. You think Arthur Andersen is gonna blow the whistle on their biggest moneymaker? Please, they made more from Enron Consulting than most companies make in a year. So every quarter, when billions of dollars got shuffled into fake entities, Andersen just looked the other way. Or worse, they looked and approved it. Here's the really insane part. These SPES needed capital to actually function. So Enron had to get investment banks and institutional investors to fund these ghost companies. How did they convince them? Enron's stock. The deals were backed by Enron's own stock price, which means if the stock tanked, the whole thing fell apart. Enron was literally keeping itself alive with its own stock price. It's like a video game character fighting its own reflection, except the reflection is made of lies, and the character is severely concussed. February 2001, Jeff Skilling gets promoted to CEO. Kenneth Lay stays as chairman, but Skilling knows. Deep down in his fraudulent soul, he knows the game is ending. Enron is running out of cash. The special purpose entities can't hide the losses forever. The stock price is the only thing keeping them alive, and it's getting shakier every day. 6 months later, August 2001, Skilling resigns, cites personal reasons. What he actually means is, the sinking ship is about to sink and I'm gonna go sell $60 million worth of stock on my way out the door. He's replaced by Kenneth Lay, the guy who came up with this whole mess in the first place. Now running the company as the fraud was imploding. Around this same time, a woman named Sharon Watkins, a vice president, sends an anonymous letter to Kenneth Lay. She tells him about all the accounting improprieties, the fraud, the whole criminal enterprise. Lay ignores it. She meets with him in person. She explains the extent of the fraud. He still does nothing, because doing something meant exposing himself. October 2001, Enron is forced to report a $618 million quarterly loss. The special purpose entities couldn't hide it anymore. The fraud had gotten too big. A few days later, the SEC launches an investigation. December 2001, Enron files for Chapter 11 bankruptcy. $60 billion. Gone. In months. The stock that was at $90 per share, basically worthless. Here's where it gets even worse. Tens of thousands of employees get laid off. But here's the kicker. A lot of these employees put their 401k savings into Enron stock. Company retirement accounts. It was supposed to be safe. Now, worthless. Meanwhile, the executives take $744 million in salaries and bonuses right after the bankruptcy. They're leaving the lifeboat with the money while everyone else drowns. The Senate calls hearings. Andrew Fastow, the guy who orchestrated the accounting fraud, takes the Fifth Amendment. Won't answer a single question. He's not dumb enough to incriminate himself on C-SPAN. Kenneth Lay takes the Fifth. Jeff Skilling actually testifies. Claims he knew nothing about the fraud, that Fastow was acting alone, that he's just an innocent CEO who happened to hire a financial criminal and promote him to CFO and give him access to all the company's money. Sharon Watkins testifies and basically says this man is lying, but in a professional way. The truth comes out from prosecutors. Fastow directly cooperates. He tells them that both Skilling and Lay knew exactly what was happening. They created these entities together. They knew the special purpose entities were backed by Enron stock. They knew the losses were being hidden. In 2006, Jeff Skilling is found guilty and sentenced to 24 years in prison. Kenneth Lay also found guilty, but he dies of a heart attack before sentencing. The universe apparently gets a vote too. Andrew Fastow gets 10 years initially, reduced to 6 because he cooperated. Okay, so here's the thing about Enron that everyone conveniently forgets. At its peak, it was the 7th largest company in the United States. 7 out of 330 million people. Every single investment bank had analysts covering this stock. Goldman Sachs, Morgan Stanley, UBS, all of them. And not one of them figured it out. Not one analyst, not one trader, not one financial advisor, not one portfolio manager said, hey, maybe we should actually understand how this company makes money before we load up on stock. One journalist, one named Bethany McLean at Fortune magazine, wrote an article called Is Enron Overpriced?, where she just asked the most basic questions. How do you make money? Can you explain your business? Why are your financial reports incomprehensible? And she got destroyed by Wall Street for it, called a skeptic, a naysayer, someone who didn't get it. The bottom line, the entire system is designed to not ask questions. It's designed so that as long as the stock price goes up, nobody cares. As long as the revenue number gets bigger each quarter, nobody cares if it's real or fake. This is why day traders are idiots. This is why people on CNBC making bold calls at 6 a.m. are idiots. This is why your financial advisor is probably making money off your stupidity more than your actual returns. And look, I'm not a financial advisor, and I'm certainly not telling you what to do with your money. But if there's one lesson from Enron, it's this. If you can't understand how a company makes money, you shouldn't invest in it. And if the Wall Street consensus says a company is genius while you have basic questions, trust your gut. Enron wasn't exposed by regulations or auditors or analysts. It was exposed when it got so big it finally collapsed under its own weight. That's the system you're investing in. If you like this dark dive into corporate fraud and financial incompetence, you gotta check out our previous video on Palantir. We broke down how Wall Street hypes up another revolutionary company and why the hype machine never stops rolling. And don't forget to subscribe so you don't miss the next corporate disaster we're gonna dissect.